Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello, everyone. Welcome back to another episode of Blind Spots. Today's video, we are going to be doing a follow-up episode to our last one. That one was called The Secret to Building Wealth, where we talked about the simple equation to building wealth, whether you are working, retired, or about to retire. So in this episode, we are talking about the secret to keeping wealth, and it's a lot more simple than what people might think, but we find that a lot of people overcomplicate it. So we will be covering the mindset shift from working to retirement, some of the pitfalls we see people fall into that puts their plan at risk, and some things you can do on the investment side to ensure that you keep the wealth that you have built.
And this is probably the most simple yet misunderstood pitfall when it comes to retiring. And it's the subtle mindset shift. And it turns out the skill set for building wealth and keeping wealth are completely different. Let's start with the former, building wealth, which we covered in our last podcast, where you're taking risk, you're trying to expand your balance sheet and save and invest. Maybe you're taking on debt, you're speculating perhaps, you're maybe investing in startups. You're trying to build wealth, either slowly or quickly or somewhere in between. You're in risk-seeking mode, you're embracing risk. Once people retire, it's really hard to turn that off. And there's external forces too that kind of condition us to think that way. Like there's so many self-help books out there, like good is the enemy of great is one that sticks out to me. And it's like, do you want to achieve more? Do you want to reach your goals? Do you want to have a better outlook on life? It all is centered around this risk-seeking mindset. And I think that's what makes America great. But there's a slippery slope with that. If you fail to turn that risk-seeking mindset off in retirement, you could be seeking risk or taking risk where the payoff just is not in your favor. And Warren Buffett summed this up nicely. He said, quote, "Don't risk what you have and need for what you don't have and don't need." So the example I tell our clients, it's like, look, you've done a really good job of building wealth. If you take your 3.2 million and turn it into 5.5 million, sure, that might make you feel good, but it's not going to drastically improve your life. You take your 3.2 and turn it into 1.1, your plan is completely off the rails. So don't take risk don't risk what you have and need for what you don't have and don't need. Yet so many people do that either consciously or doing it without even knowing it. And our job is to help them downshift, to be content and to be happy with what they've built and then go focus on life's other things.
This idea just popped into my mind that I think I've seen a lot recently, just with some conversations that I've had, is that there's this idea that, and we've kind of talked about this in the past, with doing more now rather than waiting for retirement to do it. I think a lot of people are in that wealth building mode and they're saving, they're investing, they're not letting themselves enjoy the things that they have. And then they go full force into spending, doing things as soon as they hit retirement, and it sets them up for this unrealistic expectation of what lifestyle they're going to live. Because if you do that in your first couple of years of retirement, you kind of get used to that elevated lifestyle of spending more than what you were when you were working, because you see this kind of pile of money that you have to use that you weren't touching before, and it, I don't know, just kind of gives you this unrealistic expectation for what your lifestyle is going to be going forward.
Right. So there's the relentless pursuit of more or not being content with what you have on the investment side. So there's several things that rear up that I've seen. And then there's some things on the planning side, like Aaron's talking about, where someone might have various leaks and it just introduces a risk of ruin in their plan that really doesn't need to be there. And we can share some examples of how folks that we know, clients that we have that have introduced a risk of ruin in their plan. And it might be a small percentage, but as we've seen from the last couple of years, some weird stuff can happen. And our job is to create a margin of safety for our clients. So even if their plan doesn't go according to plan, or even if they make a suboptimal decision, it doesn't wreck them. But history is riddled with people in the net worth of the billions going off the rails. And it all stems back from not being able to put their flag in the ground and say, okay, my body of work is done. I've built my enough. Now I'm going to go just enjoy the fruits of my labor.
So I want to go back to one of the first things that you said is that the secret to building wealth is very different, or quite the opposite of the secret to keeping wealth. So how would you compare the two of those? Because going into this episode, I would have argued that they're actually very much so the same.
So think about this.
Yeah,
so it's a mindset shift. So I'm 41. Like, people think that since I invest people's money and I write about investing, that I am very active with my personal investments, and I'm not. I don't even look at it. I barely even trade. I just save. I'm a 100% equity investor, and I don't care if I lose 40, 50%. Like, I don't like that, but I wouldn't even blink because I'm in wealth building mode. I know I'm not going to touch that money for a long time. I'm going to focus on the things I can control: my savings rate, my emotions, my attitude towards risk, building a portfolio that reflects the way that I feel about risk. So I'm just focused on saving and investing, letting time and compounding do its thing. All right. So that's very much a risk-seeking, wealth-building mindset. Someone who's retired, like, I'm not saying 100% equities is good or bad for them, but you at least have to be mindful that your career is over. Your human capital is basically tapped out. You're not going to be working or earning anymore. So that mindset shift goes from, hey, I'm going to squeeze as much out of this 100% equity risk-seeking, to, okay, I need to be a bit more prudent. I don't need to speculate. I don't need to take outsized risk. I need to be more measured and more patient. And that's the subtle mindset shift that I'm talking about. But the disconnect is people don't turn it off. People can't turn off the wealth building, wealth seeking, aggressive mindset when they transition into retirement. And it's a subtle shift, but it's very much an important one.
Okay, so I think that this goes to show the way that our minds think about things, the same thing, two different ways. Totally agree with everything that you just said. The way that I was thinking about it is kind of the logistics, and probably more just so the planning side of things, in that whether you're building wealth or you're trying to keep it because you've retired or you've hit that point where you found your enough, that the kind of simple equation that we've talked about is that it's simply living below your means. So whether you're working and saving, you have to live below your means to have that extra to save for the future. And if you're retired, you have a finite amount of money left over. You still have to live below your means in order to ensure that it lasts for the rest of your life. So that's where I was saying that I would argue that the approach is the same. So I guess it depends whether they're opposite if you're talking about your mindset, but they're the same approach if you're talking about kind of
the planning side,
logistics of it.
Is a little bit different than the investing side. So I'm talking purely through an investment lens, where I see someone that maybe was a 100% equity investor in their career, and they still want to be a 100% equity investor in their golden years. And a good example of this, of the mindset shift, like, I dabble in startup investing. Like, a lot of my personal net worth is tied up in the public equity market. So I'm like dabbling in startups. And look, a startup investment that pays off could be life-changing, but like, you need a run rate. Like, you have to understand that whatever you're investing is very much likely to go to zero. Okay. I'm fully comfortable with that risk, and I understand the wide range of outcomes. If someone approached me with a startup investment pitch, and I'm 65 years old and I'm retired and I'm not working, I'm probably going to tell them to pound sand. One, because I don't have the time to see it through. I'm not interested in swinging for 100 baggers at that point in my life. Like, at that point, I should be content with what I have. And that's what I'm talking about. Like, something that you would embrace during your working career, a startup investment, a venture capital investment, a loan, a real estate deal, you would probably at least look at it through a different lens once you are retired, especially if have more than enough. And that's a different number for everybody. But again, it doesn't make sense to risk what you have and need for what you don't need and don't have. Like it just doesn't make sense.
Absolutely. I've got to ask this question because there's got to be at least one other person that's listening to this podcast that is also as confused as I am. What is 100 baggers?
You invest $1,000 and it turns into $100,000. So you 100 times your money. Never heard that? Oh, it's like a trading
never heard
mental shortcut. Like these
before.
guys on Twitter were like, oh, I hit a 10 bagger on XYZ stock, and that means you 10 times your money.
My thought was that it was going to be some kind of like
is. It kind of is a baseball thing, but people got a little carried away. 100 bagger, 1,000 bagger, 100x, 1,000x, same concept.
Interesting. No. Okay, so I risked myself to sound stupid just to clarify this for someone else. Okay, so let's talk about kind of the pitfalls that we've seen and how we help people through it. So let's start on the investment side. Just we've talked about making decisions.
So I'll talk about just the general things that I've seen. Some are investment related, some are maybe not. But okay, so this is for people that are retired that are doing things that increase their risk of ruin. Okay, taking on debt. Right. So you're retired, you don't have debt, and you take on debt to buy a second home or a third home or buy an investment property. Taking on leverage in general expands your range of potential outcomes. And this is most common in real estate. And a lot of folks up until recently, it seems like every single cycle where rates are low and real estate goes up, they think that real estate is a foolproof way to build wealth. And it's a great way to build wealth, but there's the other side too. And I think the equation changes when interest rates go from 3% on a 30-year mortgage to 7-8%. Folks that are getting into Airbnb investing are finding out the equation is a lot different. So taking on debt. Second one is, and these are all things that I've seen, performance chasing in the best performing stock. So a certain area of the market goes up, someone wants to change their long-term asset allocation to over-allocate to the best performing asset classes. I wrote a blog a couple weeks ago about how it's almost a certainty that the best performing managers, advisors, and mutual funds and strategies and themes are the worst performing the next part of the cycle. So there's a reason why the SEC says past performance is not a guarantee of future returns, and that's why. And then kind of back to what I said, like taking risks that you don't need to, or hearing people pitch you when you don't really need to do that, like startup investing or just investing in riskier corners of the market, trying to hit that 100 bagger or trying to find the next Amazon. That's okay to do with the small portion of your capital. But when you start to dip into your long-term portfolio that you're living off or that you need, it becomes a potential problem. Right. So like and
a large percentage of it too. And that's kind of what you said with, use a small portion of it. Don't take out 20% of your portfolio.
So one thing that we tell our clients to do, and this is probably flies in the face of what a lot of advisors say, but if someone is active and wants to invest and wants to express their active views and themes, that's great. Do it with 5 to 10% of your investable assets. Set up a online brokerage account and scratch your degenerate itch. That's fine, because some people need an outlet for that. Where it becomes a problem is when you start to dip into that long-term portfolio and make decisions that, again, increase your risk of ruin. The last thing I'll say, I don't know what it is, but I've noticed this more often lately. But constant tweaking or restlessness, buying and selling homes, making decisions with no context of how it impacts your plan, changing your goals and priorities on a whim. There's many causes to this, but I think a big part of it is we're absorbing a lot of information, and we talk a lot about an information filter. And I just think people don't know how to process what's meaningful and what's meaningless in an era that they're just getting reams of information day after day. So just in the last 6 months, we've had clients buy third homes with the premise of they're going to sell their primary home. And if you haven't noticed, the real estate market's changed. We end up having clients that bought a home, had to borrow money or take a bunch out of their investment portfolio, and they're unable to sell their home that they were planning on selling. And now they're stuck with 3 properties and 3 property taxes and 3 mortgages. That's what I'm talking about. That increases your risk of ruin, and you don't need to do that.
Yeah, that's definitely been something that's happened as of late. So let's talk about some of the things that we do to help our clients with that, and how we help mitigate some of those
So I'll talk about what I
decisions
do,
that
and then you
could put
can
them at risk.
maybe share some of the planning things that you do with like this, with the scenario analysis and just showing people the impact of their decision. So the first thing I do is I talk about it. So I talk about this for every person that's about to retire or freshly retire. I talk about the mindset shift, and I've written several blogs. One, February of 23, more is the enemy of enough. And then one of my most popular posts from October of 2020, what is your enough? Helping people quantify what their enough is and being content with what they've built rather than keep trying to build wealth, or the relentless pursuit of more, as I call it. So Aaron can link those in the podcast notes, but I quite simply just talk about the mindset shift between building wealth and keeping wealth. And a lot of people haven't even thought about it. And it's a simple thing, but I found it's a very hard thing for people to downshift and to be patient and to be prudent and to be more mindful with their money decisions. Aaron, why don't you talk about some of the things that you've done on the planning side to help model some of these decision points?
Yeah, so our financial plans we call them foundational financial plans, because it's kind of your baseline, it's your guide for your life or for the next several years of retirement. And we use our financial plans as a decision center. So we run any decision our clients want to make through their financial plan to see what the actual impact of that decision is on kind of the rest of their life. So one of the big things that we do is stress testing the plan for their breaking point. So some different scenarios could be, what if the market has a pullback of 30%? How does that impact your plan? And that's, of course, within the context of how they're actually invested. Other scenarios that they want to see, like we said, buying another house or another property, or investing in their cousin's startup, those kinds of things we can run through the plan. Even down to stuff like buying a car, if you should lease it, if you should finance it, if you should pay in cash. Another big one is gifting to charities, giving to kids, supporting kids. That's another we help run through the plan. And that leaks into, anything in planning snowballs really quickly, because it affects your taxes, it affects your withdrawal rate.
So let's use the second home as an example, because that's a popular one. So Aaron would basically run the current scenario, meaning you're not going to buy a second home. The popular one. So she's got your foundational plan. She would run that out over the next 10 years, let's say. Then you would come to her and you would say, hey, I'm thinking about buying a second home in the desert. She would model that, the purchase price. If you need to take the money out of the portfolio, she would model the tax impact. Obviously, if you buy a second home, you might need to buy new furniture. You're paying property taxes, so your monthly expenses are going to go up. She would run not buying the house, buying the house, run that over 10 years to show the impact on your entire plan, and then give you information on the impact of that decision. Now, we can't tell you what to do. I mean, a lot of these are lifestyle things. I can't tell you not to buy a second home and not enjoy the sun in the desert and all that stuff. But we want people to make data-backed decisions, because money can be emotional. People have preconceived notions about what's true and what's not true. We're trying to center them and at least arm them with the proper inputs, and then you can decide, or you and your spouse can decide, if that makes sense.
Yeah, and just going off of the example of buying another home, I think it's helpful for clients mostly is just thinking through how this all plays out, because there's a lot of things that people don't consider when they're buying a second home. Kind of like you said, you've got to pay property taxes on both places. Now you potentially have a mortgage on two places. Furnishing another home. If you're buying a home that's not brand new, there's probably updates or different things that you're going to want to do at some point. There's repairs and maintenance for two homes. And people don't consider the ongoing cost outside of just the purchase price. And that can often make a pretty big impact on someone's plan negatively. But talking through the logistics of what purchasing a second home would look like. Oftentimes it's a vacation home or a place that they're going to spend a couple months out of the year at. Just thinking about how far away is this home? What's the barrier to get to that home? Do I have to get on a plane? Am I going to want to do that? Am I physically able to do that? Maybe I can do it today, but what does 10 years from now look like? So it's just having a conversation about how your lifestyle changes by making that other decision can help people talk through it. And it's over and above just what the numbers say most of the time is what helps people get to the
put a
decision
bow on
of whether
this,
it's the right thing
there's
for them
really
or the
two
wrong
things
thing
that
for them.
stick out. One is the mindset shift for building wealth and keeping wealth are different. Okay. And then the other thing is once you are retired, to keep your risk of ruin as low as possible. And that really delves into the planning side. I feel like the relentless pursuit of more and downshifting into being content with what you have, I feel like that manifests itself more on the investment side. So those two things, once you retire, you need to turn off the aggressive risk-seeking mindset and downshift. And then once you're making decisions, money decisions in your retirement, make sure you're working with a financial planner. If you're not, have them model, or you can model these various scenarios. At least try to project the range of potential outcomes. I can't tell you how many times people make emotional decisions and then come back and realize that they've made an absolute mess. And look, you only get one shot at retirement. Like, time is not on your side. So the importance of every money decision goes up exponentially. And look, we're not trying to scare anybody, but there are tools out there. There are advisors out there that can help you unpack and make sense of a lot of this stuff to keep your plan off the rails and your risk of ruin low.
Very well said. So we will have the blogs that Nick mentioned in the description below, so you can check those out. But we hope you enjoy this episode, and we will see you in the next one.